Hello, everybody, and welcome to our webinar today on buying a business, how to undertake due diligence. My name is Nina Vanderlaan, and I'm a senior associate in the corporate team here at LegalVision. Really happy to have you with us today. So before we get started, a couple of quick housekeeping items. So firstly, you're going to receive a recording of this webinar and the slides that we go through to your email address once the webinar is complete. At the end of the webinar, during the webinar, there's a Q&A box. Please pop your questions in there, and then at the end of the session, we'll have a little quick Q&A session. I'll go through as many of those as I can. At the end of the webinar, you'll receive a pop-up feedback survey. Please complete that. We always love to hear how people find these. In addition, after the webinar for the next 48 hours, you are eligible for a free consultation with LegalVision, in which we can discuss with you how we might be able to help your business. So to the extent you'd like to take us up on that, please provide your contact details in that survey I mentioned, and we can reach out to set that up for you. So you'll see that a poll's popped up on your screen along this agenda slide. This is going to remain up for 2 minutes only. So please answer the question to let us know what your main concern is around undertaking due diligence. So what we're going to be discussing today, what is due diligence? Why is it important? What the process usually is for due diligence, the different areas that we typically look at as part of that process, determining what sorts of information are important that you should be focusing on, how to reduce your risk from any issues that you might pick up during the due diligence process. We've compiled a handy dandy due diligence checklist to work through. And then, like I said at the end, we'll go through some Q&A. So let's get into it. What is due diligence? So due diligence, which is often called DD, and you might hear me referring to it like that during this webinar, is a process of investigation or audit into a company or a business that you're thinking about buying, with the purpose being to get a clear picture of its current and historical performance, financial position, legal arrangements and relationships with third parties, assets and liabilities, and to confirm information that's been provided by the seller. Due diligence usually involves inspecting business records, physical assets, and it might even involve meeting with the staff of the business that you're considering buying. Often, due diligence is undertaken with the assistance of a number of parties, such as lawyers, accountants, and sometimes other corporate advisors as well. For the purposes of this webinar, we're going to focus on two types of due diligence in the context of business purchases, which is often referred to as an asset sale, and company purchases, which is often referred to as a share purchase. So, why is due diligence important? There are a few key reasons. Overall, the objective is to give you, as a buyer, a snapshot of the business or the company at a point in time to put you in a position where you can do the following things. Firstly, and arguably most importantly, make an informed decision as to whether or not you want to proceed with the purchase of the business or the company. Number two, so that you can understand risks or potential liabilities that exist and mitigate those risks or liabilities to the extent that this is possible. Number three, understand what it is that you're paying for in order to assess the value of the business or the company and therefore what an appropriate purchase price is. Number four, determine whether you want to exclude any assets of the business from the sale. That typically only applies in the case of an asset sale. Number five, where you're undertaking a share purchase but only part of the shares of a company, it's important to understand how your relationship to the other shareholders will operate after after the company's shares have been purchased. And then number six, to identify any issues with the business or the company, which you can then work through with the seller prior to agreeing and prior to the transaction going ahead. So this might end up looking like adjusting your offer or the terms of the sale and purchase agreement, and that can look like negotiating adjustments to the purchase price or the indemnity provisions to protect against risks and liabilities that have been identified, or sometimes, where the findings justify it, to walk away from the deal entirely. So if you're considering purchasing the assets of a business or the shares of a company, we always recommend carrying out due diligence for these reasons. Right. So before we move ahead, I've just got the results of the poll, and it looks like, we've got a pretty even spread here, but looks like the key focus that people want to understand about is managing the risks and issues that arise, which I can absolutely understand. We'll get to that in due course. So thanks for popping your answers there, everyone. Right. So let's talk about the process. So, as to the timing of due diligence, when does it happen? This can vary a lot, and it often depends on the size and or the complexity of the business or the company that you're looking at. So, for larger transactions, due diligence is usually conducted after a term sheet is agreed and signed, but before a formal sale and purchase agreement is finalized and entered into by the parties. Um, and the reason for that is because that enables the parties to kind of have a look at everything about the company and negotiate any things that they might want to see reflected in the ultimate sale and purchase agreement. When it comes to smaller transactions, due diligence is usually carried out after the sale and purchase agreement is signed, and that's during a conditional period where satisfactory completion of due diligence is included as a condition to that agreement. And then the agreement doesn't become unconditional until that process has been followed. So, as to the length of time that's put aside to undertake due diligence, this will also depend on the size of the transaction, which will usually also dictate the scope of the due diligence that's undertaken. So the next slide shows the process that's typical of a larger transaction. So we'll go through this now. The first step for getting due diligence underway is for the buyer, or if you've engaged advisors, to submit what we call a request for information or a due diligence questionnaire. This is shared with the seller and it contains questions regarding key aspects of the business or the company, and it asks for copies of certain business records and other documents. Once that's been submitted, the seller will then respond to the questions and provide copies of the requested documents, following which those are reviewed by the buyer and the advisors. Often, if the transaction, well, especially if the transaction is large, or there might, in some situations be multiple potential buyers carrying out due diligence, the seller might set up what's called a data room. The data room is basically like a virtual storage room, such as a shared Google Drive or a Dropbox, in which the seller uploads the requested key information about the business or company. And that will typically include copies of key documents like employment agreements, material commercial contracts, and financial information. All sorts of things go in there. The virtual data room will then act like a central repository, if you will, where all information relating to the DD is stored. Once the buyer and their advisors have reviewed the initial information that's provided and identified any points that require further clarification, there's normally follow-up questions sent to the seller for their response. And usually we see this done by way of a Q&A document, which is uploaded to the data room so both parties can access and sort of update that document. This process usually results in some more documents being uploaded and supporting materials being added to the data room. To the extent that a buyer has advisors involved, the advisors will then prepare a due diligence report for the buyer, which highlights any key issues or concerns that have been identified with the business or company, along with recommendations as to how the issues identified could be resolved or the associated risks reduced, again, to the extent that this is possible. The amount of detail that's contained in that report will depend on a number of factors, such as the size of the transaction, the buyer's risk appetite, and the level of detail that the buyer has instructed the advisors to go into. So sometimes that includes limitations like only reporting on material risks, as compared to sometimes reporting on all risks, which are identified during due diligence. In those bigger transactions where buyers are sometimes more sophisticated, we're normally only asked to identify and report on material issues, and sometimes that includes a financial materiality threshold. In smaller transactions or where a buyer hasn't been engaged in investing or buying businesses companies before, then the scope of the due diligence support that we provide tends to be wider. So, what kind of information do we look at? There are various types of information that we typically review in order to assess the risks and liabilities associated with the business or company that's been looked at. This, of course, can vary depending on the nature of the transaction and the industry that the business is involved in. But we'll run through some of the key areas that we would typically see a buyer and advisors looking through as part of due diligence investigations. So the first one here is the corporate structure. This is particularly relevant in the context of a share purchase. So this involves ensuring that the buyer has a good understanding of who owns the company. So that's who the shareholders are, who's running the company, i.e., who the directors are. And it also includes reviewing the company's governing documents to the extent it has any. So that would be the constitution and the shareholders agreement. We also typically review like the certificate of incorporation, board and shareholder meeting minutes, trust deeds, if there are any, and then any other organizational documents which can verify the company's legal structure, the ownership, and governance. So, how decisions are made in respect to that company. The next one there is commercial contracts. So this involves reviewing all the contracts or material contracts with customers, suppliers, any other third parties. And what we're looking for there is any significant obligations or potential liabilities that exist under those contracts. We also look for change of control and assignment provisions or other contractual limitations on the business or the company's shares being transferred. And like I said, yeah, often this review will be limited to material contracts. The next one here is leases. So we look at the terms of any lease which is associated with the business or company or that the company is a party to. And that, we normally look at how much time is left on the existing leases, what is the rent and any other expenses that are payable under that lease, what the permitted uses for the premises or any restrictions that apply to that use. And then we just kind of look for any other key considerations present that, a buyer would want to know about. So the next two are related financing arrangements that involves looking at any loan agreements or other financing arrangements that the business or company is party to, and that's in order to understand the key terms of those arrangements. And then we'll also look for any securities which are registered on the Personal Property Securities Register and Land Information New Zealand if any property is owned, to see what securities need to be released upon settlement of the purchase. And so the way that that relates to financing arrangements is because typically lenders will hold security over certain assets in the company where debts are owed to it. And to the extent that those are not coming with the purchase, you'll want those to be released before the assets come across. So legal and regulatory compliance, this involves assessing the compliance of the business or company with applicable laws and regulations that apply to the relevant industry, and confirming that any required permits, certificates, or licenses that are needed are in fact in place in order to undertake that business. On the next slide, we've got a few more litigation and disputes. So we're interested in understanding what the company's litigation history is, if there's any ongoing disputes it's involved in, or any threatened legal actions against the company. This helps, of course, to identify potential liabilities the company could face, reputational risks, and any material litigation that could impact the value of the assets or shares that are being acquired. IP is important. We look at the portfolio that the target business or company holds. So that includes what's set out there: trademarks, copyrights, trade secrets, licenses, and any patents. We also review the relevant registers so that we can understand where rights are registered, or on the flip side of that, where they're unprotected. This can help to identify the strength of the business's IP rights, any potential infringement issues, and the need for any IP assignments or licensing agreements. So this is particularly relevant, where the business is very IP heavy, like for a software business, for example. So employment matters, we look at employment contracts, policies, benefits, and compliance with employment and health or safety laws to understand the business or company's workforce structure. Again, looking at potential liabilities that exist, employee disputes, and any pending or threatened employment litigation. So for assets, and again, particularly relevant for an asset purchase, we look at property that's owned by the business or company, which includes both tangible and intangible assets. We're looking to evaluate the asset portfolio and potential liabilities to inform whether the proposed purchase price is appropriate. And it's also important to ensure that the seller has the appropriate rights to transfer ownership in those assets if that's required. So insurance coverage, we look at existing insurance policies, the business's claims history, so that we can understand the extent of the coverage that exists, any existing claims, and potential gaps that might exist in coverage. So a few other additional considerations which may come up or not depending on the industry. We might look at environmental assessments, product liability, cybersecurity, regulatory permits, import or export compliance, and then just anything else which is relevant to the proposed transaction. And so also key to making an informed purchasing decision are things like, on the financial sides of things. So financial statements, balance sheets, income statements, cash flow statements, and tax returns for the business or company. These sorts of documents fall into what we would call your financial due diligence, and these are usually reviewed by the buyer's accountant. So that side of things will help to determine how the business has been operating to date and its ability to make a profit. And this really highlights the importance of having both a lawyer and an accountant working together on your due diligence. So in terms of determining what's important from the information that's provided, this really involves assessing the relevance of the information to the transaction at hand and the potential impact on the buyer. So, to determine what information is relevant, there are a few factors that can be considered. Um, firstly, the specific objectives of the transaction and the buyer's reasons for buying the assets or shares. This can often help to prioritize the information needed and to evaluate whether those objectives can be met. Risk allocation, so that's as to the risk between the parties, so the buyers versus the sellers, and whether the issues that have been identified are going to be at the buyer's risk after the business or company changes hands. So to the extent that it's remaining with the seller, of course, there's no risk that exists for the buyer there. So the potential financial impact that the information might have on the transaction. We typically focus on information that can significantly affect the valuation of the business. And so that's the purchase price, such as, profitability, cash flow, or the overall sort of financial health of the target company or business. Um, we look at the legal and compliance risks that might arise from the operations or the information that, that's been identified. We look to identify potential liabilities, litigation, regulatory non-compliance, or breaches of contract that could have legal consequences for the buyer after the transaction settles. We typically focus on information that may expose the buyer to legal risk or to impact the company's ability to operate or transfer its assets. And finally, here we've got red flags and warning signs. Um, we look for ones that could indicate potential risks or issues. Again, this might include things like unusual transactions, conflicts of interest, undisclosed liabilities, or any inconsistencies or discrepancies in the information that's been provided. As I noted before, potential buyers sometimes specify a materiality threshold. So that means that the buyer is only really concerned about risks which might incur a liability for them over a specific monetary amount. So they might say, we're only interested if it's potentially going to result in a loss to us of more than $10,000, say. And this can be a really useful guide point for us when we're conducting due diligence. Okay, so how to deal with issues that come up during due diligence and reduce your risk. So, I think the first important thing to say is there's always risk involved when buying a business. It's impossible to completely eliminate risk. But what the purpose of due diligence is, as we've talked about, is to help the buyer to make the most informed decision possible about the business or company. But won't eliminate all the risks that are present. So to the extent that key risks have been identified during the due diligence process, there are a few options that we sometimes see buyers or advise buyers on in order to minimize those risks. So to the extent that the issues are deemed significant, the buyer can engage in negotiations with the seller to discuss potential resolutions that might be appropriate, depending, of course, on what the issue is. This could look like renegotiating the terms of the sale and purchase agreement, adjusting the purchase price, or revising contractual provisions to address the concerns. And that in particular could look like the seller giving additional warranties and indemnities in terms of the issues that have been picked up. It might also be appropriate to add additional pre-completion conditions which must be met by the seller. So that's where, something's been picked up, this buyer's not happy with, and they say, we're not prepared to go ahead unless you resolve this particular issue before we take the business over. And then, whether or not the seller's able to do that, that'll be a point of negotiation. And then ideally, that will be completed prior to settlement. In the context of an asset purchase, sometimes it's appropriate to obtain what's called a turnover warranty from the seller. So, a turnover warranty is a type of warranty that's given to the buyer from the seller about the future turnover or revenue of the business that's been sold. So, the warranty assures the buyer that the business will achieve a certain level of turnover or revenue after the transaction is completed. And then, to the extent that the actual turnover or warranty or revenue falls below that warranted level, the buyer often has recourse to seek remedies from the seller. So, that might be repayment of a portion of the purchase price. Another potential option to build that can be built into the agreement is an earnout provision. So this basically allows for payment of part of the purchase price to be deferred after settlement and paid out over time. And then those amounts will only be due upon the business achieving certain agreed milestones post settlement. And that's usually financial performance targets. We often see this being used in a situation where the seller and buyer can't come to agreement on what the appropriate value for the business is. On the other side here, we've got post-acquisition resolution. So this refers to issues being resolved after the business or company has changed hands. And so whether or not this is appropriate will depend on the issues that have been identified. We usually suggest putting a plan in place, which might involve the seller or might not, but alongside the assistance of advisors, that can be helpful. The approach of trying to resolve issues after acquisition should only really be used where the issues identified are easily fixable and they're not likely to cause significant financial loss or risk to you as the buyer. So a good example of that is where, the advisors have identified that the business has got terms and conditions in place, which might not be quite up to date with current law. That's the kind of thing that can easily be resolved and updated by the buyer after the settlement has occurred. And so that's an example of the sort of thing that you might defer until post acquisition to deal with. Okay, so let's look at the due diligence checklist, which is a bit of a summary of what we've already discussed. So first thing to do when you're considering buying a business and you're wanting to undertake the due diligence, get your due diligence team together to the extent that's required. So your lawyers and your accountants. Get onto the next step of requesting the documents and the information from the seller. So the corporate information, material contracts, business assets, and financial documents. Once you've got all that information in hand or in the data room, review the information that's provided, and to the extent that you pick up on any information that's missing, request the additional information or ask additional questions as required. Once the review's been undertaken, preparation of the due diligence reports typically occurs, again, to the extent that advisors are involved. The due diligence report gets pulled together based on an assessment of all the information that's been gathered. Once the due diligence report has been provided, that will include identification of the issues and risks that are present. And so then once that's been assessed, take the steps to reduce the risk. So potentially negotiating the purchase price, requesting those additional warranties and indemnities from the seller, or making a post-acquisition plan as that's appropriate. Finally, making a decision on whether or not to purchase the business. Okay, so that includes the main part of our webinar. Thank you so much for your attention. You'll see here that there's a reference to our publication Due Diligence Guide for Purchasing a New Zealand Business. You can access that in the resource tab or by scanning the QR code here if you want some more information, some reading material for later. We also have an upcoming event that you might be interested in that's called Overdue to Paid, How to Take Control of Your Business Debts. That's being held on Tuesday, the 29th of April at 11 a.m. If you'd like to register for that, you can do so at the URL there. Okay, so the next thing we're going to go to is Q&A, but before we do that, we'll just take a minute to talk to you a bit about LegalVision's membership. So by becoming a LegalVision member, your business will get unlimited access to our full team of over 100 specialist lawyers for all of your business as usual legal needs. It's like having your own in-house counsel, but at a fraction of the cost. Our team is able to assist you with unlimited document drafting and reviewing of business contracts, unlimited legal advice consultations, and unlimited domestic trademark registration, and much more. You can think of our membership as having your own in house counsel. We'll take care of all the business as usual legal work so you can focus on running your business. And if you are in house counsel, we also offer a dedicated service to manage your high volume business as usual legal tasks. We also, of course, regularly support clients with their business sale and purchasing needs, including providing due diligence support. If you would like to learn more about our membership or how Desk Extension can help you, please do request that free consultation when the survey appears at the end of this webinar. Okay, so let's go to some Q&A. So we've received a few questions. I'll just have a quick look. So great question. Is it important to have the documents reviewed by both accountants and lawyers? And so, look, the answer to this is it depends. Um, Obviously, from our perspective, we consider it very important to loop in both accountants and lawyers, as both sides do bring like unique expertise, which helps to ensure that a thorough and effective due diligence process is undertaken. Um, what we really seek to do with our role is ensure that you're going into the proposed transaction as informed as possible, and with the right advice to make sure that you reduce the risks that can be present. A lot of the things that come up in due diligence can be tricky for a buyer to assess on their own, unless you have some specific relevant expertise yourself. And it can also be relevant. It can also be tricky to assess the relevant risks that are associated with the information that you are provided with. Um, and the way that that information is going to, or that risk is going to impact you as the buyer or the business going forward. So that's really the side where the advisors add value. Um, we look in terms of like having the two different parties, we look at it from different perspectives, obviously, and that helps to ensure that all the potential issues, or to the greatest extent possible, have been identified and captured, and you can really get a complete picture of the business that you're thinking about buying. Um, Although I know, one of the things that kind of holds people back from engaging advisors is the cost that's associated with it. Um, we like to say, the way to think about it is that although that can seem like a large upfront cost, um, it helps to avoid potentially bigger costs and headaches that come up in the long run. Um, and that's by identifying those issues before they become problems. Whereas if you buy a business without that support, the risk of you encountering those problems, you might not find out about certain risks and issues until you're actually in the business running it and owning it yourself. And in that scenario where the due diligence hasn't happened in the front end and you haven't built in the relevant protections in the sale and purchase documentation, you might find yourself in a situation where you have limited recourse against the seller, for the issues that you've then found. Um, so, although I will say, with that all being said, it does, of course, depend on the specifics of the business proposed purchase. So, for example, if you're purchasing a business that has a really low value attached to it, there's minimal assets. Um, it's not always necessary, or it's not always appropriate to engage advisors. So, um, it might be that you either do the due diligence on your own, or you can sometimes, we sometimes assist clients, where it's a low value business purchase, just with a very light touch. So we give some guidance, but we're not doing the full review and generating the report. So yeah, the long and short of that is, absolutely valuable, helps to protect you, but ultimately a question for the buyer as to whether or not you're going to go down that path. Just looking at other questions that we've got here. How long does the process take? So yeah, like I said in the presentation, this can vary significantly depending on the nature of the transaction. I would say that for like sort of your smaller to medium-sized businesses, the ones where the sale and purchase agreement is entered into first, and then due diligence is a condition of that agreement. we normally see like a 20 working days period entered as the conditions timeframe. Um, Often that's extended. The parties get to the end of that time frame and they haven't quite completed due diligence to their satisfaction, and so the parties will agree to extend it. So I guess anywhere from like 1 to 2 months is how long that process can take. When it comes to larger or more complex businesses, it can be several months, and there can be multiple rounds of going back and forth to make sure that all of the relevant information has been provided. It's ultimately always a balance between ensuring like a thorough enough investigation to enable a buyer to make an informed decision, and mitigate the risks that come up, with the need to like sort of move forward with the transaction. So yeah, could be any length of time really. Just had a question come through about vendor finance on some part of the purchase price, what to look for and how LegalVision can assist in this space. Yes, we see vendor finance all the time. I think it's becoming increasingly common. Um, it's ultimately a negotiation between the parties as to what vendor finance is going to look like. I would say it's pretty uncommon for vendor finance to apply to the entire purchase price. Like typically, vendors um, vendors will want to see some commitment upfront from the purchaser, and just some cash in their pocket as well. So um, but it's definitely common to see a good chunk of the purchase price being by way of vendor finance. And then as to, how long the period of repayment is, the repayment terms in terms of, is that all going to be repayable in one chunk at the end, or is it sort of a monthly repayment? What is the interest that applies to that? That's ultimately something to be negotiated between the parties. But like I said, very common to see, and we often prepare vendor finance agreements as part of our suite of business purchase documentation. Let me see, we've just had another one come in. We were told the turnover warranty relates to guaranteeing the turnover you supplied was correct, not a warranty for after. How could you have influence on the sales and operations of the business post-sale and provider? Yes, yeah, great question. So I guess there are two different types of warranties that can be offered. So one is a warranty where the vendor will say, here's the amount that the business earned up until this point in time. That obviously has that's useful for and important for a purchaser to understand what that looks like, but that information can also be gleaned from doing a review of the financial statements of the business. And to the extent that a vendor has given a turnover warranty for a historical time, you would want to verify that that number is correct as part of your due diligence, and that's the financial due diligence that we're talking about there. It's less common, I would say, in small businesses, small business sales, to have a future warranty given, because as you say, there's obviously a lot of risk associated with that for a vendor because that is out of their control. And so vendors can be hesitant to provide those types of warranties. But I would say it's definitely more common in a larger transaction where there's a higher, like a bigger purchase price, where there's more risk for the purchaser. Sometimes there are situations where they're saying, look, we've identified these risks and issues as part of our due diligence. We're not going to be comfortable going ahead unless we've got some certainty from you or some right to recourse, that the business is going to continue on in the way that it has to date. So again, as with all of these sorts of things, it's ultimately a matter for negotiation between the parties. Providing a future turnover warranty puts the vendor at risk, but is something that a vendor is sometimes prepared to do, if they really want to get a deal over the line. All right. So let me see what else I've got here. Um, I've got a few questions here about process, factors to consider. I think we've pretty much captured all of these. There's a question here about company contracts, which is just making me think about one of the other sort of important aspects of due diligence and of purchasing a business is kind of managing those relationships with third parties. And that includes not just, suppliers and customers, but employees as well, people that work for the business. And so in the course of kind of undertaking due diligence, to the extent that you are getting in contact with those sorts of third parties, obviously, in order to ensure the ongoing success of the business after you've purchased it, um, just always bearing in mind to be looking to maintain those relationships, grow those relationships, introduce yourself as the buyer of the person who's going to be taking those relationships on. Um, and that's just something important to bear in mind as you're kind of looking at the third party relationships and getting in touch with those parties. Okay, so there's no other questions that's come through. So we'll just wrap it up there. Um, like I said, there's going to be a survey that pops up at the end. If you could please complete that for us. And if there's any other questions that you think about that you'd like answers to, feel free to pop those in there as well. Um, and so while this is a free webinar, we really value your feedback, love to improve these to the extent that we can. So please do let us know what you thought today. Thank you again for your attention. Thanks for joining us, and hope you have a great rest of your day.